Hello everyone, welcome back to Fun with Fitzee. This is Chapter 6, Video 4. This is getting into just the basics of inventory valuation methods, and you're going to learn that inventory valuation is one of my favorite topics, and I'm not even kidding about that this time. So let's talk about using actual physical flow costing. So before I do that though, let's talk about why we need to value our inventory. As you know, sometimes when you buy inventory, you could buy it one day. Let's talk about something very simple, like a pen. And let's say I bought a pen one day, one pen, and it cost $1. So therefore, I have $1 worth of inventory. Let's say I bought one pen the next day, and the price for me went up to $2. I still have only 2 pens in inventory, but now my cost of inventory is actually $3. So at the end of the day, when we take our beginning inventory and our ending inventory and throw it into our cost of goods sold formula, remember our cost of goods sold formula equals beginning inventory plus net purchases plus freight in minus ending inventory equals our cost of goods sold. So this is why we're doing all of this basically, is because this ending inventory number we need to value. And if you count these pens, let's say I sold one of these pens, and I don't know because I didn't keep track of which one of them, what is my ending inventory going to be? I only have one left, so is it going to be $1? Those are going to be $2. I don't know because I don't know which one of those I sold. So when I talk about valuing inventory, this is what we're talking about when I need to value inventory. So there's several methods to do this, just like with depreciation or amortization, there's different methods. Well, for valuing inventory, you're going to see there's different methods as well. The first method is the specific identification method, and it tracks the actual physical flow of the goods. So if we go back to my example again, where we have 2 pens, in this particular case, I would know which of these pens I sold, so I would know exactly if I sold this one, then my ending inventory would be $1. And vice versa. If I sold this one, then my ending inventory would be $2. And it really determines, so the price changes when we buy inventory really could affect what our ending inventory is. So in the specific identification method, we know exactly which ones. And companies that use the specific identification method are companies that sell high value goods, like a car dealership or jewelry stores. Each item of inventory is marked, tagged, or coded with its specific unit cost. So if I sold that pen, I would know which one it was. It is most frequently used when the company sells a limited variety of high unit cost items like we just talked about, like the jewelry store or the car dealership. Now there are other cost flow methods that we can use other than the specific identification method because it's not always practical. Picture a grocery store with boxes of foods and cans and whatnot. They don't always know exactly which can someone took off the shelf. So in fact, it would be really impossible to use the specific identification method. So valuing an inventory for that company would be tough. So we need to come up with some methods of doing this. And these methods assume flows of costs that may be unrelated to the physical flow of goods. So what we're saying is we're going to track the flow of costs, but it might not actually be the particular item. So if we go back to my pen example where I had the $1 pen and the $2 pen, well, some methods might take the first in, first out, which means if I sold one pen, I would assume that this one is gone and this one is still there. When in fact, a customer may have actually taken this one. The physical flow, which means the one the customer took, doesn't always match the cost that we're going to assume here. So the different cost flow assumptions that we can look at are first in, first out, which is what I just talked about. We assume that the first one that we bought here is the first one the customer took, which means we have a $2 pen left. There is an average cost method, and there also was a last in, first out method, which was the opposite, in fact, where we would assume the last ones in were the first ones out. And this would work really well like in a bulk barn situation where you fill up the bin with the product and the customer scoop the top ones off, they're actually the last ones in are going to be the first ones out. Now, the Canadian Institute of Chartered Accountants, you recall them being called CICA, and they're the ones that are responsible for our GAAP procedures. Well, they have recently since taken out LIFO as an appropriate method. So what we're going to do is we're going to look at first in, first out, and average cost, which is going to make your life a little easier because you don't have to differentiate between these two. Okay, so that was just a quick introduction. Our next video is going to actually look at FIFO and LIFO. FIFO and average cost. And but by now, you should definitely be able to name and explain different methods to evaluate inventory. And that's pretty simple. FIFO and weighted average. Thanks for watching. Hope this was helpful. See you next time.